everybody. Welcome to Friday. Uh, thank God it is Friday. Beautiful day. Hey, Joe. Uh, what's happening? Good to see everybody. Nice to see you. Arlene. Uh, yes, Madeline. I thought you were skipping me, but I see you popped in there, Madeline. Good to see everybody. So thanks for coming. It's a beautiful day, so I won't try and labor on it today. Perfect day. Um, Nice temperature. So the other thing today is most of this is going to apply to condominium associations and co-ops. So it's generally not going to apply to single-family homeowners associations for the most part. There is a caveat to that. Um, there are, I guess, what you would call fee simple townhome associations with attached units that these things may apply to because many of those setups are not truly fee simple. The association actually has various responsibilities in terms of replacing roofs, exterior siding, etc. So you'd have to be careful and talk to your insurance professionals in particular about that and to see which regs apply in terms of townhomes if they apply at all, but they certainly apply in condos and co-ops. And you'll see why in a second. So the dog of the day, we have the dog of the day today. And by the way, we need dog of the day. Hi, Greg. Haven't seen you in a while. Nice to see you. So the dog of the day today is Maylee. Maylee for the first day of May. There's Maylee, and she is. Let's see. She is a mix of lab and greyhound, they think. I don't know that they have had her genetically tested. I don't know about that lab and greyhound, but we'll go with it. 7 years old and belongs to Shannon Velez from Executive Property Management right here in North Brunswick, New Jersey, Executive Property Management, the Barber family. So thanks so much, Shannon, for sending in Maylee. Really nice. And Maylee will be on the calendar next year, which is awesome. Thanks. And as I said, we still need dogs for those of you who haven't sent in your dog yet. And if you haven't gotten a calendar, the calendars are still around. We still have a few left. So that's that. And then, as you know, the preliminary announcements I always have to make. So annoying, the lawyer announcements that says, this is provided for general informational discussion purposes only. They do not and cannot form an attorney-client relationship. The information does not constitute legal advice. To go out and get legal advice, you have to hire a lawyer, either us or somebody else, and we'll be happy to work with you if we don't work with you already. The information will not be kept confidential, so don't put wacky stuff in the chat or don't say anything if I unmute your mic that you don't want your husband to know about, because he will learn that. The other thing is, too, I want to make you remember or remind you that June 5th is the next First Friday with Fran, and June 5th will be on the summer schedule. So we'll be going to a noon start time on June 5th. So we'll start at noon because it'll be the summer schedule, summer hours. Because I do know that most of my property manager friends are doing property inspections on Friday afternoons in the summertime. Many of those inspections take place on Sandy Hook, but who knows? Who knows where they're going to be? So anyway, let's jump right into it. So what is Fannie Mae and Freddie Mac? So they're federal housing agencies, right? They're not, I shouldn't say they're federal. They're quasi-governmental entities that facilitate liquidity in the residential mortgage market. And what their job is to try to, in theory, encourage home ownership, provide liquidity in the market, and also buffer defaults. So try to make sure that you don't wind up in a 2008 situation where everyone's getting foreclosed from their homes, right? So they want guardrails on lending, underwriting, insurance, how associations are run, and especially with respect to the mortgages that they're either guaranteeing or that they're buying, right? So Fannie Mae and Freddie Mac doesn't lend to me and you. They lend to other lenders that then lend to me and you on our mortgages, right? So they buy tranches of mortgages and help the whole mortgage industry run. As part of that, they set rules. These are the rules um, that are going to apply to qualify for Fannie Mae or Freddie Mac guarantee or purchase guidelines, and they're called conforming loans. They conform to Fannie Mae and Freddie Mac guidelines. If they don't conform, they're non-conforming loans, and then you're going to have to go find a mortgage somewhere else. So if your association does not conform to the guidelines, you will not be able to get conforming loans. Oftentimes, you have to go through a different loan application, find a different loan, like a VA loan, an FHA loan, or a USDA loan. I don't think you're going to see many USDA loans in New Jersey, but you will find VA or FHA loans. You also will find other non-conforming loans, but typically they are more expensive. They may have higher interest rates. They may have higher fees. They may have more stringent requirements in terms of the home inspection and what repairs must be made prior to the closing. So there are non-conforming loans if you want to go out there and get them. As association board members and property managers, you don't have to, you're not compelled to make sure that your association can get conforming loans, conforming mortgages. Nothing I know of compels you to do that, but it does increase marketability of your unit, right? Because the sellers and the buyers will have access to that market, right? It's just easier to sell homes. So in March 18th of 2026, Fannie Mae came out with new guidelines, which Freddie Mac is more or less cross honoring, and they're the two quasi-governmental entities that are in this business. And one thing that's interesting, we've talked about this years back, probably 15, 20 years ago, one of the requirements was you could have no more than 15% of your association be investor owners, right? 15%. And that was probably 15, 20 years ago. And then in 2008 or 2009, they bumped that up to 50%. They said if you have 50%, if you have more than 50% investor owner units in your community, we won't lend to you. Well, Fannie Mae stripped that requirement out entirely as of March 18th, 2026. That's effective immediately. And what does that do? That opens up the floodgates, if you will, to investor owners, right? So that your community can, and I have one or two communities that are 70% investor owned, which is a very, very high percentage. But that won't knock you out of FHA, I'm sorry, Fannie Mae or Freddie Mac compliance. It is interesting. It's an interesting development because the government, regardless of which administration is in power, says words like, we are trying to discourage these massive private investment companies from sucking up all of these private residential units. It seems odd that they then would take the cap off lending in associations. You see what I'm saying? It seems counterintuitive. If they're trying to discourage people like BlackRock from investing in blocks of housing, residential housing, why would they take the cap off? Seems kind of strange. But the 50% max cap is off. Nevertheless, many of you know this already. In many associations that we work with, especially the ones in awesome locations, associations are having us do bylaw or master deed amendments to restrict the number of rentals or the percentage of rentals, or install a seasoning provision that says you must be owner occupied for 1 year, 2 year, or 3 year before you can turn it into a rental unit, right? So that would be called a seasoning provision. But again, the 50% max is now off the table. Increased reserve requirements. So this is an interesting requirement, I think, and it somewhat conflicts with the state requirement. So there's a federal requirement under the Fannie Mae guidelines. Reserve allocation requirement for capital expenditures and deferred maintenance increased from 10% to 15% of the annual budgeted income assessment. So that means if you're a condo or a co-op, and I think, again, this applies to some townhouse communities, you must be able to show that 15% of your total budget for the year is dedicated to reserve funding, right? And there's an interplay with the state law on that, right? Because what the federal guideline says, you're required to have 50% of your budget dedicated to reserves. If you do not, you can rely on your reserve study to show that you're meeting the reserve study requirements. But if you're using your reserve study must be funded at the highest plan within your reserve study. So for those of you who've looked at engineering reserve studies recently, generally they provide three levels of funding. One, baseline funding, which is more or less a zero threshold. It never goes below zero. A threshold type funding, which is usually, say, 20 or 25% threshold, and then a full funding, which is the highest level of funding, which is fully funding each line item according to its depreciation schedule for useful life. Um, if you're a condo association or co-op and you're looking at these numbers, if you're below 15% in your budget and you still want to be compliant with Fannie and Freddie Mac, make sure you talk to your engineering reserve company and make sure that they put a reserve program in there that you can afford if that's going to be your compliance method, right? Baseline won't work. Fannie Mae refuses to accept baseline funding, so it can be a a percentage funding, but you don't want to have in that report a full funding option because Fannie Mae says if you have multiple options to comply, you must go with the highest option, right? So you don't want to get boxed in with the highest option. So that's the enhanced reserve study requirements. So if the 15% requirement is not met, the association must obtain a reserve study to demonstrate that it has sufficient or adequate reserves. But it must be that you're adopting the highest funded plan in the engineer's study. So be very careful about that if you're trying to preserve your Fannie Mae and Freddie Mac. What about the property insurance updates? So Fannie and Freddie came out with insurance updates, and this kind of surprised me a little bit. So the master policy coverage must equal 100% of the estimated replacement costs with the exception of roofs. And this is a new one. I really don't understand it. Fannie Mae and Freddie Mac say the reason they did this was to increase affordability of property insurance in associations. So it looks like they're going to require 100% of the estimated replacement cost to be insured, except for the roofs. And from my reading of their ruling letter, it seems to be that you could cover the roofs at actual cash value, so more or less a depreciated amount, which in my mind really increases risk, especially if you have a fire that takes out an entire building, right? You lose the entire roof. And oddly enough, we've probably had 3 or 4 fires this year. But I guess you could say, what are the odds that it would take out all roofs in an entire community, right? Say a community with 15, 20 buildings. This is also an interesting thing I thought. The max master policy per unit deductible is $50,000. So in New Jersey, I don't know what you're seeing out there, but in condos and co-ops, I have not seen, I don't think, a $50,000 per unit deductible yet on property insurance. I don't know if show of hands if anyone has a $50,000 one, but that's pretty high. I thought that was pretty high. The most I see in New Jersey generally is 25. And that's what I regularly see is 25 on the master policy. But Fannie Mae and Freddie Mac says, okay, $50,000 is fine. However, and this is where the gotcha that bites you in the hiney, but the unit owner must have unit owner property insurance covering the greater of any portion of the interior of the unit not covered by the master policy. Or the amount of the per unit deductible in the master policy, right? So even though Fannie and Freddie is allowing the association's deductible to float to 50, they're demanding coverage on the back end purchased by the unit owner to cover anything not covered by the master policy or the total amount of the association's deductible if it's up to 50 grand, right? So they're winding up with coverage anyway. So Fannie Mae and Freddie Mac are worried about their own losses there. So they're giving the association a bit of a break, but they're taking it right back from the unit owners themselves, right? As far as I can tell. The other thing that they're concerned about is the max unit owner policy deductible would be 5% of the property insurance coverage amount or or 2,500 bucks. So they're not letting the unit owners have huge deductibles either to get around their premium. So the unit owners are going to have a cap on their deductible amount. So I think what you're going to see as this filters through the system is um, is unit owner insurance increasing, right? The homeowners actual, most times it will be an HO6 policy. I don't know if this is going to impact HO3 policies, but for the most part, I think it's going to impact all HO6 policies. Um, in terms of the increased reserve requirement, so the elimination of the 50% investor owner, that is effective immediately. Um, the increased reserve requirements in terms of 15% applies to community loan applications on or after um, January 4th of 2027, right? So it's going to be phased in a little bit. You're going to see loan applications that come in. They're going to be asking that question January 4th, 2027. The enhanced reserve requirements in terms of the funding plan adopted by the association, they're going to be asking about that with respect to loan applications um, submitted on or after August 3rd of 2026. Um, the max policy deductible in the association's policy of $50,000, that would be for loan applications after July 1st, 2026. Who's going to see the impact on this most in terms of administration is the management company's resale office, right? The people who fill out the resale certifications are going to have to deal with all this stuff. And what is the answer for all of this? Be truthful, right? Be truthful, right? Because many times property managers are pressured because a seller wants to sell a house, they want to get conventional financing, and the property management team is pressured to say, yes, we have this funding plan in place and it's being fully funded because they want to move units. But the fact of the matter is, never, 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 never stick your neck in the noose for anybody else. Okay. So if you're filling out loan certifications with respect to mortgages, resale certifications, et cetera, make sure you do it truthfully. And I know you can get pressure from homeowners, you can get pressure from the board, you can get pressure from the on-site manager, but the management companies have to ensure that these resale certifications are filled out truthfully, or you will see action taken, I'm sure. Um, that was really quick. I hope that wasn't too quick. That was really quick. I don't know if I saw any questions. There's one or two down there. I know it was a bit dry, but I had to get it out there because this is new. And I know many of you are kind of like glazing over because you're in single family homes. But this will be impactful with respect to the condos and the co-op world. We have a huge issue with investor-owned units over 65%. Yeah, so Shannon says, hey, we have over 65%. So that's tough if you're over 65%. The question there is you can be over 65%, but how does it impact the quality of life? How does it impact the nature of your community? I have associations that have wonderful investor owners. I have associations that have investor owners that don't give a rat's behind about anything other than the check hitting the PO box. And that is a huge problem, right? Because they expect the property manager to manage their tenants, and that's not the property manager's job, right? So you wind up with tenants who are animals, and the unit owner doesn't care. We have a situation right now, unfortunately. Chris Brocious, I don't know, he's one of our attorneys. I don't know if he's on the call with us today, but we've been dealing with a tenant in this association who has been a real problem. And we were trying to, let's say, manage the situation for some time. And then, shockingly, this past week, a fire occurred in his unit and it damaged a number of units there. Luckily, knock on wood, nobody was hurt. But it's a problem, and the unit owner herself, was not effectively dealing with that tenant. Um, how can we go about assuring our residents can get a reverse mortgage? So that's from Christina. So in terms of a reverse mortgage, generally that would be a little different than Fannie Mae and Freddie Mac. You generally have to go through I believe, the FHA process. I haven't done that in a while. Um, but it certainly can be done. Um, I would reach out to a reverse mortgage broker and ask them what they need first. Maybe I can do a future session on that. I haven't been involved in qualifying associations for FHA reverse mortgages recently, but I have done so in the past, and maybe we could have a session on that. So I don't know what the updated requirements are. Um, but many active adult communities, if you will, age-restricted communities, they do use them as a resource, right? Especially in the ones that are older, I have seen, right? So where they've aged in place for quite some time. Because as you know, for many people, even older people, their largest asset is their home. So they're house rich but cash poor, and they need to find a way to pull some money out of their house to cover medical expenses, living expenses, et cetera, especially when you get down to, unfortunately, end of life issues and you have huge medical bills, treatment bills, rehab bills, on and on and on, right? All of us are eventually going to be talking about end of life issues, which are, not easy issues and not easy to pay for, right? So really, really becomes very difficult at that point. So this is easier said than done. The shoemaker's shoe, children always go shoeless. I don't have a long-term plan for end of life issues myself, but we should all be talking about long-term end of life issues, how we pay for it, how we're going to live through it, where should we live, and who will be making our end of life decisions for us, right? Because if you're not prepared for that, you're not going to be happy. My board wants a residency amendment. So Shannon says, I assume what you mean by that, Shannon, is basically either capping a percentage or having a seasoning provision that you have to live in the unit as an owner for a certain period of time before you can rent it. So we can do that. That would be a membership vote to get that type of amendment in place. Will we be able to have the recording of this webinar? I really like to review the insurance part, and thank you. Yeah, so Kim says, hey, can we have a recording and can we talk about it? Yeah, so it's recorded and it's usually posted on our website, not our website. I guess technically it is on our website, but it's also on YouTube within a week or two. There's some editing and fooling around that goes into it. The other thing is, and you hear me preaching about this all the time, and I think most of you do this, is your insurance broker should be either Zoom or in person visiting with the board at least once a year to talk about these issues, right? So your insurance broker is generally more knowledgeable than me on these issues because he or she is dealing with it every day and trying to get the proper insurance in place um, such that the association can get maximum flexibility in terms of liquidity and mortgaging units. And the same goes for your reserve professional. So they can speak to you about how the plan can be shaped and still comply with either the 15% budget requirement or the highest plan in the reserve study so that you're eligible for Fannie Mae or Freddie Mac financing. And that's it. Wow, that's the fastest one I think we've ever had. I don't even get to listen to myself talk very long today. But it is really nice. It is really nice out there. If I had known this would have been so short, I would have had a glass of wine today and we could have just like chatted for the next half hour. And but I do not have a glass of wine with me today. But it is great to see everybody. And I thank you so much for coming out. And I hope you have a fantastic weekend. Enjoy the weather. And I will see you at noon next month. Remember, at noon. Okay. Great to see everyone. Thanks again for your time. See you soon. All right. Bye bye.